Good morning. My name is Alex Roger. I'm a partner at Lathrop GPM and want to welcome you to the webinar today. It is part of a series we've been doing on insurance-related issues pertaining to the coronavirus pandemic and the stay-at-home orders and shutdown. And now that it looks like some states are starting to reopen, but there is still some significant issue about whether we're going to have a second wave and whether we might have to face more closures, we thought it would be a good time to talk about legislation that is pending in states and at the federal level, trying to help policyholders who by now have probably gotten some bad news from their insurance companies about their claims. So that is me, in case you were wondering. And I'll also put up my information at the end of the webinar. If there's follow-up questions that weren't addressed, we're happy to take them. The webinar itself is going to be recorded and will be available on our website. So if you feel like you need a refresher, feel free to take a look at our website and get a copy of the webinar slides there. Also, at the end of the presentation, I'm going to leave some time for questions. So you have a chat function, and you can feel free to use it, but I won't be answering any questions until the end. So one of the main issues that we have seen with property and business interruption insurance claims. Clearly, with all of the forced closures across the country, businesses have been hurting. They've had to shut down. They've had no choice. And many of them are saying to themselves, well, if this isn't business interruption, I don't know what is. And they've made claims under their policies. But I wanted to give, before we get into the nuts and bolts, I just wanted to give those of you who maybe aren't familiar with property and business interruption coverage just a very, very high-level overview of the types of coverages available. Typically, your property policy will cover you for your direct physical loss or damage to property. The most obvious example would be if a fire or a hurricane comes through, a tornado, and destroys your property. You'll be covered for that physical damage to your property. But as a separate coverage, and sometimes it's referred to as business income, sometimes it's referred to as business interruption, but oftentimes it's referred to as time element coverage. In any event, no matter what it's called, it covers you for your loss of business income and any extra expenses you might have due to the halt, suspension of your operations. So in the example of a hurricane or in the example of a fire, your property is covered, but in the meantime, while you're rebuilding, you've had to shut down, and so you've lost income. And that insurance is there. It typically lasts for about a year. You get a maximum a year of coverage of lost business income, but again, every policy is different. Civil authority is an additional coverage that's provided that gives you the loss of business income and extra expense, but not because your building or your location has necessarily been physically damaged, but it's because there's been some physical damage somewhere else, and that has resulted in an order restricting access to your location. So that is probably sounding very familiar, and it is a coverage that many policyholders are seeking right now relating to the coronavirus-related closures. And finally, contingent business interruption essentially insures you for any loss of business income due to physical damage to a property or a location in your supply chain. So if you're a restaurant, for example, and you rely on a particular vendor or purveyor of meat or poultry or vegetables, etc., and that location burns down, and as a result, you're out of luck and you have no ability to do business for a certain period of time, contingent business interruption covers you for that event. So with these coverages in mind, business income claims have been made by virtually every policyholder holding a property business interruption policy. And but there are two main issues with the business interruption claims related to the COVID-19 pandemic that is different from other types of losses. Direct physical loss or damage is the threshold question. You have to have some direct physical loss or damage to trigger coverage, whether it's to your location in the case of your, the time element or business interruption, or whether it's to a vendor's location and contingent business interruption, or in civil authority to some other location that causes an order restricting access to your property. There still has to be some direct physical loss. And in many states, and I guess I should add at the outset that unlike many laws, insurance law is not uniform. It is, every state has its own insurance code, and every state has its own principles for interpreting insurance policies. So a lot of the answers to these questions could differ depending on what state you're in. One of the questions is physical alteration to property required? That's an obvious question, and it's a question that's probably rarely asked in your typical claim, because either it's obvious that there's some physical alteration to property. If your property burns down or a flood comes through, that's obvious. But it's not as obvious when there's a virus, because the virus, while it does contaminate potentially your property, it can contaminate the air inside your location through someone's coughing or sneezing, etc. It doesn't necessarily change your property, alter it in the same way that a fire or a flood does. So depending on what state you're in, it may be that actual physical alteration to property is required, in which case it's obvious why the virus might not satisfy the direct physical loss requirement. And in some states, for example, California is a good example, where I'm sitting right now, there is some law that is favorable on this issue, and that has found that complete loss of use of property is essentially physical loss. That may also depend on the language of your policy. Some policies say direct physical loss of or damage to. Some just say physical loss, and courts have parsed that language differently. However, depending on what state you're in, you might be able to make a claim for loss of use. In any event, the burden is on you as the policyholder. That's always the case. I don't think there's any state that puts the burden on the insurer to prove that there isn't coverage. The initial burden is on the policyholder to at least make a prima facie case that there is coverage under the policy. So then that leads to the following question. Well, due to the total lack of testing at the outset, testing is increasing now, but for the past few months, we've had no ability to test. And at the time when the closures were ordered and the stay-at-home orders were issued by the various governors, there certainly wasn't any ability to test. So how does the policyholder establish that someone exposed to the virus was at their location It's possible if they have an employee that has tested positive that could meet that burden, but again, that's going to be tough for a lot of policyholders, simply because of the nature of how this all occurred. And but that doesn't necessarily mean that policyholders are out of luck. There might be some other ways to prove viral contamination. I mean, if, for example, you're in an urban area where the infection rate is very high, you might be able to make an argument that, look, I don't have proof that there's any particular person entered my property, but it's certainly more likely than not that they did, just given where I am. So, again, it's an issue that all policyholders are going to have to address across the board, and it's an issue that insurers are relying on to deny claims. And then finally, I wanted to point out that even if you can meet your burden, a virus is different from, fire. A fire, it's going to take a long time to rebuild or to restore your property. But a virus is different. A virus, presumably you can go in and clean the location, and, there should be no reason why you couldn't stay open. Of course, that does not deal with the issue of the forced closure orders. But again, it just provides another argument or, an arrow in the insurer's quiver to deny coverage. So the next issue that I wanted to discuss is the virus exclusion. And sometimes it's a specific virus exclusion or an express virus exclusion. Sometimes it's a pollution exclusion that includes virus in the definition of pollutant. Sometimes it's an exclusion for microorganisms. It can even be a communicable disease exclusion. But most policies on standard property forms do include a virus exclusion. It was included about 2006, roughly 15 years ago, in response to the bird flu and the SARS epidemic. Now, interestingly, if your policy doesn't have a virus exclusion, you might want to argue that, well, if I don't have a virus exclusion and you knew that viruses might be covered under policies, then I should be covered here. But in any event, most policies that we're seeing, a lot of them anyway, do have specific virus exclusions, and some of them are extremely broadly worded so that, there really isn't a lot of room to argue that, for example, the issue isn't necessarily the virus, but it's the disease, for example, because in this case, unlike in many pandemics such as HIV, getting the virus does not necessarily mean that you get sick. There are a lot of asymptomatic individuals, but some of these exclusions are extremely broadly worded. And in all events, the insurers have been making a universal denial of claims for coverage. I have yet to see a claim that was accepted. And I think the reason is probably quite obvious, that there are the pandemic, unlike a hurricane or something like that might be vast, but it's still localized. In this case, it really touches almost every property policy that insurers have, at least any business interruption property policy with business interruption coverage. So, you can understand why the insurers are going to just fight this tooth and nail, which is exactly what they are doing. All right, again, we're having a little trouble advancing the slide, so there we go. All right, so this is essentially, a bit tongue-in-cheek, obviously, but it is essentially the response that, all policyholders that I have seen are receiving. No insurance for you. Next. And that leaves policyholders with really two options. One option is to sue, which of course is not ideal for various reasons. Number one, many policyholders just can't, I mean, they're closed down. If it's a small business, they don't have the luxury of some sort of, liquid cash on hand that they can invest into litigation, which is likely going to be fought very, very strenuously by the insurers. So it's just not a great solution. And it takes time. And by the time, even after you've hired a lawyer and you've invested the money, there's certainly no guarantees, and you can have appeals. And anyone that's been involved in insurance coverage litigation knows that while policyholders have been able to make great strides, it takes time. And unfortunately, at this time in our history, policyholders just don't have time on their side. So the only other option is legislation. Now, it is surprising to a certain extent that there really have not been very many states that have taken the mantle and really tried to fashion some legislation that could help policyholders. The first to do it was New Jersey, and that was back in late March. And since then, there has only been 8 states and Puerto Rico that have proposed legislation. Once again, we're having trouble forwarding the slides. There we go. But all of the legislation is essentially the same. Now, I don't want to give you the impression that they're exactly the same. Some of the language is from state to state, but they do vary. And I'm certainly not intending to give you a detailed analysis of every single bill, but I wanted to just touch on the key issues, which is where are they pending? What is the likelihood that they're going to help policyholders if they're passed? And what's the likelihood that they'll pass? And so I wanted to just provide here on this slide, the 2 points that the legislation in the 8 states that have, and Puerto Rico, that have proposed it essentially does. Number one is, for the most part, the legislation provides that the COVID-19 pandemic is a covered cause. It's a covered peril. And the language here is essentially the language that's used in most of the proposed bills. What it's saying is that they are going to, as a matter of law, we are going to interpret every business interruption policy to cover COVID-19 pandemic and the virus. They're also saying, and by the way, if you have an exclusion, you're not going to be able to argue that that exclusion applies, and you're not going to be able to argue that there has been no physical loss or damage. All right, next slide. Thank you. So here's a summary of the coverage legislation. Now, there might be other bills that are pending in these states that relate to maybe costs for, cleaning up viral contamination and other things. But I just wanted to give you a summary here of the 8 states that are actually proposing legislation that would provide policyholders the ability to collect, recover their lost business income. So, this is in order, alpha order. Louisiana is, they're all retroactive with the exception, I believe, of Michigan. Michigan is also retroactive, excuse me. So the policy, the bills propose retroactive coverage during the state of emergency. In other words, during the governor's declared state of emergency and until it's rescinded, coverage for the COVID-19 pandemic, and they direct the insurers not to rely on any virus exclusions or make any claims that there is no direct physical loss. In Louisiana, they have also, the mechanism is a little bit different because they are also attempting to establish a fund that both policyholders and insurers could opt into to get their losses paid. If the policyholder were to opt in, they would pay 80% of their losses, and in exchange for that, they would waive any claims of bad faith against their carriers. In New York, there's an additional provision that would provide for automatic renewal of your business interruption policies at the current rate. So, a lot of policyholders that are making claims might expect that they, might not get renewed given the risk. So at least in New York, they're proposing automatic renewal. And, all right, next slide, please. In Pennsylvania, there are, if you can see, there are various bills that are slightly different. Interestingly, at least one of them does not specify the number of full-time employees. All of this legislation, it's important to add, applies really only to small businesses, which are defined slightly differently, but generally 150 or fewer employees, some states 100, some states 250, but this is not going to save, the Fortune 500. This is really intended for small business. In Pennsylvania, they're not limiting it to a particular number of employees, but they're distinguishing between small businesses that will receive 100% of their policy limits and others that will receive only 75% of their policy limit. So if you meet the small business criteria under this, under SB 1114, you would get 100%. If you don't meet that criteria, if you are a large company in Pennsylvania, you would get 75%. None of these bills have yet passed. You can see that they've all been sent to committees and they've been sitting there for a while. So it does not appear that any of them are on the cusp of being passed. In New Jersey, excuse me, for example, New Jersey was the first state to introduce legislation, and there was immediately a full frontal lobbying assault by the insurance industry on the legislature in New Jersey. As a result of that, it appears that there's been some negotiation, and I understand from news reports that the insurance industry is going to make their own proposal. So it's entirely unclear, if or when that legislation would pass. In Louisiana, it looks like at least the legislation that would directly require payments to policyholders may not be really viable at this point. So, the insurance industry has certainly not missed a beat, and they are actively lobbying in each state. As a result, it remains unclear whether or to what extent or in what form any of these proposed bills are going to pass. Next slide, please. So, along with the relief for policyholders, The legislation in these states also provides some relief to insurers. Understanding that, as I said before, this pandemic has touched virtually every policy, property, business interruption policy that has been issued. As a result, if insurers are forced to pay policy limits, that is a tremendous loss. And legislatures have recognized that they need to do something if they're going to make insurers pay claims on all of these policies that they've issued for the COVID-19 pandemic, that they need to provide some relief. So there's different forms. Louisiana, as I said earlier, they've got they want to establish a compensation fund that you would have to opt into. Insurers would be protected from litigation, and policyholders would agree to, limit their recovery to 80% in exchange for, essentially waiving any claims for bad faith against the carriers, and they would avoid litigation as well. I mean, it's a interesting idea. It remains to be seen, again, whether it's really viable at this point. Massachusetts and other states have a different plan. They're proposing reimbursement of some percentage of the claims that are paid out by insurers through a fund that would be itself funded by the insurance industry. So in Massachusetts, the fund would be through assessments on business interruption insurers. In other words, only those insurers that are actually offering business interruption insurance. Next slide, please. Michigan and New Jersey have no proposed insurer relief legislation, but Ohio, unlike New York and unlike Massachusetts, would apply for the reimbursement fund would be assessed on property casualty insurers generally, not just those that provide business interruption coverage. Next slide. And Pennsylvania as well. So, there would be some pro rata assessments on the property casualty industry, and in South Carolina, it would be on all insurers, again, though, in proportion to their premiums. So while it's somewhat different in each state, the reimbursement or relief legislation is essentially intended to provide some spreading of the risk among insurers so that it's not just specific insurers or just business interruption insurers that are hit the hardest on this. Again, it remains to be seen whether any of this will pass, but the reimbursement legislation or relief legislation that goes to the insurers is important for reasons that I'll explain in a moment. Next slide, please. Federal legislation, none of it the federal legislation proposed does not impact claims that have been made. It is not retroactive, so it would not help any policyholder that has suffered a loss of business income due to the COVID-19 pandemic. Rather, they're looking prospectively going forward at establishing a pandemic risk reinsurance program, much like they did after 9/11. They established the Terrorism Risk Insurance Association, TRIA, as it's called, and they're looking at doing a similar thing going forward for pandemics. It makes a lot of sense given the incredible stimulus package or multiple packages that were passed. So it just remains to be seen, what will happen, although it seems like there is There is some will in Congress to do that, but again, it's not going to help anyone that has, lost business income today. The other bills are also directed at requiring insurers to offer business interruption coverage due to a national emergency, but you'd have to pay an additional premium. That premium would be set at presumably at the state level. Unclear how expensive it would be. I mean, this reminds me much of the earthquake insurance. As I sit here in California, a lot of people have just decided not to buy it because it's just so expensive. So yes, insurers have to offer it, and they do, but at a level that is so expensive that most policyholders just don't take advantage of it. Next slide, please. So here we go, legal challenges. Well, as you can imagine, part of the insurers' arguments to Congress, to the state legislatures have been, you just can't do that. You just can't rewrite our contracts. Policies are contracts, and you can't rewrite them. So I expect that even if this legislation were to pass, it would likely immediately, the day it's passed, be met with a lawsuit, many lawsuits, maybe enjoined by a court from taking effect. So who knows, even if these bills are passed, whether they'll actually take effect and when. The legal challenges are pretty straightforward. I mean, they're constitutional challenges. The Contracts Clause says that no state shall pass any law impairing the obligation of contracts. The insurers policy. The question is there a substantial impairment, and is it appropriate? I mean, the reimbursement schemes are important for that reason, because they clearly, without a reimbursement scheme, I think the insurers will probably have a pretty good argument that their contractual relationships have been substantially impaired. But with the reimbursement scheme in place, is there a real substantial impairment? Maybe an impairment, but maybe not a substantial one, at least not enough to meet the constitutional test. And particularly when you have a highly regulated industry like the insurance industry, I mean, there's an entire insurance code devoted to the regulation of insurers in each state. Is it really unreasonable to expect that they're going to be regulated further? So, it's unclear whether, whether the Contracts Clause claims, while at least on their face appear valid, whether they would actually pass muster, particularly in those states other than Michigan and New Jersey, where there are reimbursement schemes proposed. So, it remains to be seen, but there's no question that the insurers are going to make the argument. Next slide. And then the other constitutional argument is the Takings Clause. This is the Fifth Amendment, and I guess I should add that, on their face, both the Contracts Clause and the Takings Clause apply only to the federal government, but through the 14th Amendment to the Constitution, they apply also to states. So the Takings Clause provides that private property shall not be taken for public use without just compensation. So, the government, if they want to build a highway through your property, they have to pay you for it. Simple enough. But regulatory takings are a little bit different. The purpose here is really to make sure that if there's a public burden, that it should be shared by the public and not imposed only on certain people. Clearly, contracts, as I said, are policies are contracts, but contracts are property. That is clear under the United States Supreme Court's decisions. And as a result, the question then remains, if the contracts are property, can they be somehow taken or amended in a way that imposes a burden on the insurer without just compensation? So, you have to look at the test here. I mean, there's clearly an economic impact on insurers. I mean, even with the reimbursement scheme, there may still be an economic impact. There may be issues then with, investment-backed expectations that go with the economic impact. But on the other hand, with the reimbursement schemes in place, is that just compensation? So there's a lot of questions here, but the point really is that there are at least, non-frivolous arguments by the insurance industry that will surely be made if any of these bills pass. All right, next slide, please. So, at the end of the day, we have been telling some of our clients, maybe the state legislatures are going to come through for you. I understand it's difficult. You don't want to sue, but, let's hold off and see what happens in the states. It does not appear that any of this legislation is going to come to the rescue and save policyholders. It either for all the reasons we discussed, because of the lobbying by the insurance industry, because really it's only 8 states at this point, and really only 6 that have, really viable legislation that would be retroactive. And then even if legislation is passed, again, you're going to see arguments in the courts immediately. These are important constitutional issues. Could they go all the way to the Supreme Court? Perhaps. And that can take a very long time. In the meantime, it is highly likely that the insurers would be able to get an injunction against the legislation in the meantime, so that they wouldn't have to pay claims. And really, is that really a help at the end of the day when policyholders need help now? They don't need help next year, 5 years from now. They need it today. I mean, the good news, though, is that going forward, it does appear that Congress has the intent, the purpose in mind to provide a pandemic type insurance product that could be offered, much like the terrorism risk insurance that was offered after 9/11. And that at least provides some solace to those of us who are, worried about the economy now, but are worried, well, my goodness, what if this happens again? I mean, if we can't handle this. So that is the good news. And, at the end of the day, I think each policyholder is going to have to make a very personal decision about whether, depending on the particular language of their policy and the amount of their losses, whether they want to litigate their claims, because waiting for legislation is probably not going to be the panacea that is going to, help resolve this issue going forward. So with that, I think we have a question here. So, one of the questions is about the legal challenges and how likely they are. Frankly, from my perspective, it really doesn't necessarily matter as a practical matter how effective these legal challenges are at the end of the day, because all that matters is, can they be made, and would they have the effect of essentially pressing the pause button on any legislation that's passed? And I think that the answer to that is they probably would. And that is really, at the end of the day, why the state legislation that's being proposed is, unlikely to provide the relief that it's intended to provide, which is unfortunate. So thank you for your time today. If you have follow-up questions, please feel free to email or call, and we'd be happy to answer them if a question comes up that we were not able to answer during the webinar. And again, the webinar will be up on our website and available to you. The slides will be available to you, I think, within the next day. So thank you very much, and we look forward to another webinar in the series. Thanks very much. Have a great day, everyone.